Daniel, good morning to you.
Good morning.
We're starting to get our hands around the real implication now for different sectors and what this may mean for corporate earnings going through Q1 and possibly into Q2 here. Increasingly, though, as we see these markets tumble, there will be those who are looking for a trade on a trade. What advice would you be giving at this point as we watch these markets get cheaper?
The first thing is not to fall into the trap of trying to buy the highest beta sectors, because those are the ones that will rise faster in a V-shaped recovery. Don't believe a V-shaped recovery. So I think that this concerted sell-off, this completely enormous sell-off is creating very important opportunities. But it's creating opportunities precisely not in the sectors that many people believe to be getting very cheap. Airlines, autos, telecoms, etc. In my opinion, if you want to buy something for the long term, what you need to buy is precisely the ones that are going to be more benefited from the policy actions, which are utilities, telecoms, and bonds.
Wait. You're being discerning.
I think so.
That's not what the market wants. The market wants to sell everything at the moment.
Of course.
You're being discerning. That's interesting.
We need to do that. We need to invest all the time.
Why isn't the market being discerning?
Well, it's normal. Because we've gone from an optimistic shock. Remember at the beginning of January, when we already had the headlines of coronavirus, the markets were reaching all-time high. Everybody thought that this was going to be a first quarter hit and then everything going back to normal. Even buying into a June V-shaped recovery, I think that all of that is gone now. We've gone from an optimistic shock to a pessimistic shock. That makes sense because it came from that level of I would say exuberance at the beginning of the year. But that is precisely the reason why you need to start to think about, hey, what is going to happen in the next 18 to 20 months? What is going to be the policy action? What is going to happen in the global economy? Let's remember that 2019 was already a very weak year for global economic growth. So that's why I think you should not be looking at the most cyclical sectors, because I don't believe in that V-shaped recovery. I believe there will be a recovery.
So the message is very clear. Beware the value traps.
We were pondering where some of the buyers had gone after all the market events. I mean, there were very few days to really exit, particularly if you look at the Dow.
Yeah.
So if you had to get clearance, if you needed approval for all the types of selling, if you wanted to, you might totally have missed it. So what does that mean if we look for money that may return based on timing? We've got almost the end of the first quarter. We've got a tax year in some countries. Do you think once we get through some of those windows that you might actually see money repositioned? Because let's face it, the first quarter is now a write-off. And your strategy wouldn't necessarily be to get back in because you might lose even more than what you've lost at this point. So could the second quarter make a difference in terms of timing for some investors?
The second quarter will be important for all those reasons. It'll also be important because it will take away the idea that the recovery is starting to take shape. I think that is an important factor. So that is likely to drive bond yields probably lower, and that at the same time will drive investors to the safer assets possible. So I think, in my opinion, that if this process, which in my opinion also looks to be taken longer than expected, drags on, then investors will decide to position themselves probably in the safer assets. So you go back to the dollar, so it's a good opportunity. So you go back to gold, you go back to bonds of the highest quality, and you avoid the most exposed to emerging markets and commodities.
I'm surprised that you're so indifferent about the prospect of a strong recovery at this point, given that we've just seen the UK throw $39 billion onto the fire. We've got the monetary authorities cutting interest rates like it's going out of fashion and stepping in and providing tiered lending support for both SMEs and banks. Okay, this is the UK, but similar things are happening in other markets. Are you suggesting that there won't be a stronger response because we're at the end of an 11-year bull market where demand is already tapped out. Why will there not be a response to that kind of TNT that's just being piled on top of each other for the recovery?
There will be a response, and it will be enormous. And the enormous response will create more overcapacity, because you don't respond to a supply shock with demand-side policies. And when you implement very large and abrupt demand-side policies, that money generated by central banks and supported by governments goes immediately to the lowest productivity sectors. So it goes to bricks and mortar. And basically that creates further overcapacity on top of a problem of overcapacity that existed already and that was showing in the very weak level of growth that we saw in 2019. So the thing that you need to be aware of is, yes, there will be a massive response. Don't believe it's going to drive a growth further. Believe that it can put sort of a stop to the sell-off. It can put some level of a bottom at asset prices, but it's definitely not going to drive GDP growth and productivity higher. Actually, the opposite. It's very likely that governments decide to take a very aggressive response. Fiscal policy plus monetary policy drives a demand deflationary process and debt-ridden deflationary process added to a supply shock short term.
Daniel, thank you very much indeed.